Hello, and welcome to tonight's NYU dinner with Cleveland Fed President Loretta Mester. I'm pleased to introduce President Mester. This is not her first rodeo with NYU. In 2016, she spoke about Fed communication, and in 2018, spoke about normal policymaking now and in the future. Now, President Mester, we like the idea of normal policymaking. It sounds good, but unfortunately, since that speech in late 2018, very little has gone normally. And amidst these abnormal times, President Mester has been a data-driven and thoughtful voice, helping us better understand not only where policy is, but where not to go. And her most recent speech, Inflation, In It to Win It, discussed the need to act with resolve regarding inflation. Now tonight, President Mester will offer thoughts on our suddenly even more complex economic environment, which we all look forward to hearing. Loretta J. Mester is President and Chief Executive Officer, and I'm just going to read this thing quickly, of the Federal Reserve Bank of Cleveland, because it's long and she's super impressive, in which capacity she is a member of the FOMC. Prior to joining the Cleveland Fed, Mester was a senior executive at the Philadelphia Fed and an adjunct professor of finance at the Wharton School at Penn. She's co-editor of the Journal of Financial Services Research and the International Journal of Central Banking. She's an economics PhD from Princeton University. This introduction could have been 5 times longer. President Mester, podium is yours. Thank you for coming.
Well, thank you very much for that. I really appreciate it, and I really appreciate the opportunity to be here tonight with the Money Marketeers of NYU. Oh boy, look at that. I get to be on a pedestal. That was a good idea. How about that? Can you hear me now? All right, excellent. All right, well, anyway, I really appreciate being here, and I'm really looking forward to hearing what's on your minds in the Q&A portion of this program. I like to do the Q&A because I really learn a lot when I hear what is on people's minds. So I'd like to first present some prepared remarks to kind of get us started. And I'm going to talk, of course, about the economy and monetary policy. And not a surprise that the views I present tonight are my own, not those of the Federal Reserve System or my colleagues on the Federal Open Market Committee. So at its meeting 2 weeks ago, the FOMC raised the target range of the Fed funds rate by 25 basis points to 4.75% to 5%. Since the Fed began raising interest rates in March of last year, the cumulative increase has been 475 basis points. Now, in addition, the Fed has been allowing assets to run off its balance sheet in a systematic way according to the plan announced last May, and this is also helping to firm the stance of monetary policy. The Fed's taken these monetary policy actions because inflation is too high and it's eroding U.S. living standards. High inflation makes it hard for people to make ends meet. High inflation also imposes longer run costs on our economy. It distorts the decisions households and businesses make about getting an education or training for a new job or investing in R&D or plants and equipment. And in this way, high inflation can harm the pace of innovation, productivity growth, and the potential growth rate of the economy. So it can have lasting detrimental effects on the economy. Now, the Fed's responsible for ensuring price stability, and Fed policymakers are committed to bringing inflation back to our 2% goal. Given where we are on that journey, I plan to remain diligent in setting monetary policy to return the economy to price stability in a timely way, and to be judicious in balancing the risks as to minimize the pain of that journey. Now, the U.S. banking system is sound and resilient, but during the 2 weeks leading up to the March FOMC meeting, stresses emerged in a small number of banks. The Fed, the Treasury, and the FDIC took swift action to ensure that these stresses did not spill over to the rest of the U.S. banking and financial system. Now, had such contagion occurred, it could have undermined the public's confidence in healthy banks and prevented them from doing their important work to support the savings and credit needs of households and businesses. Now, banks now have access to liquidity through a new Fed lending facility, as well as a traditional discount window where they can borrow against sound collateral to ensure that they have sufficient liquidity to serve their customers. The stresses experienced in the banking system in March have eased, but the Fed continues to carefully monitor conditions and is prepared to take further steps as necessary to ensure financial stability. Now, in the past, when tensions like this have arisen in banking and financial markets, banks have tended to tighten credit availability, making it harder for households and businesses to borrow. In addition, if households and businesses become concerned about the outlook for the banking sector or the overall economy, they could become more cautious in their spending. So going forward, Fed policymakers will continue to assess the magnitude and duration of these effects and their implications for the outlook for inflation and employment, and therefore for appropriate monetary policy. Now, incoming economic information over the first part of the year has pointed to resilience in underlying demand in product and labor markets and persistence in inflation. Partly in response to higher interest rates, tighter lending standards at banks, and tighter overall financial conditions, economic activity has begun to slow. Real GDP grew at a below-trend pace of 1% last year, down from a very robust pace of about 5.75% in 2021. Growth in the final quarter of last year was over 2.5%. Much of that was due to firms rebuilding their inventories. Inventories aside, growth in real final sales was more modest, just over 1%. Now, the slowdown in activity is seen most clearly in the housing sector. Residential investment continues to decline sharply in response to higher mortgage rates, but actually real estate agents and home builders have told us that they are beginning to see demand stabilize. Now, there is a longer run structural shortage of available housing, which suggests that less downward pressure on prices than one might expect given the rise in interest rates. Construction contacts also indicated to us that they expect public sector spending and future infrastructure spending to support activity. Business fixed investment in equipment and manufacturing activity have slowed, but a few of our business contacts have said that they thought investment has been more resilient than expected given higher interest rates. Now, indicators suggest that consumer spending, which makes up 70% of GDP, grew at a relatively strong pace in the first quarter. This spending has been supported by strong household balance sheets and income growth. Debt-to-income levels of households have been fairly stable, and in the aggregate, households have been able to service their debt in a rising interest rate environment. Now, on the supply side of the economy, disruptions in supply chains have generally improved, although not uniformly. Contacts report that bottlenecks have eased, and survey data indicate that delivery times have shortened. And that's welcome news because price pressures can be alleviated both by further moderation in demand, but also by further improvements in supply. Now, employment growth has slowed over the past year. Firms report that it's somewhat easier to find workers now, and the rate at which people are quitting their jobs is moving down, which is usually a sign of a moderating labor market. Nonetheless, overall labor market conditions remain strong, with demand for workers outpacing supply. Payroll job gains averaged over 400,000 per month in January and February, a pickup from the average monthly pace seen in the fourth quarter of last year. The unemployment rate remains a very low 3.6%, near where it's been for much of the past year. The number of job openings has varied from month to month. They are down from their level a year ago, but the ratio of openings per unemployed worker has been running between 1.7 to 1.9 over the 6 months that ended in February, and compared with 1.2 in the 6 months before the pandemic started. Now, recent gains in prime age labor force participation may be helping to ease the imbalance between labor demand and supply, but this imbalance has put upward pressure on wages, and because labor costs constitute a significant share of a business's expenses, especially in the service sector, this imbalance has also contributed to high inflation. Since workers' wage gains generally have not kept up with inflation, many workers are not better off in real terms. By some measures, wage pressures are beginning to ease, but wages are still growing at an annual rate of about 4.5% to 5%. And that's well above the level consistent with 2% inflation given current estimates of trend productivity growth. Indeed, for wage growth at this pace to be consistent with price stability, trend productivity growth would need to be about 2.5% to 3% instead of the current estimates of 1 to 1.5%. And we haven't seen any evidence that trend productivity growth is rising. In fact, productivity growth has declined over the past year. So workers are still falling behind in their purchasing power and will continue to do so until we get the economy on a sustained path back to price stability. Now, several factors contributed to the sharp rise in inflation that began in the spring of 2021 in the US. These factors include the pandemic, and how households, businesses, and monetary and fiscal policymakers responded to it, and Russia's war against Ukraine, which led to sharp increases in food and commodity prices. Imbalances arose between strong demand and constrained supply, and these led to significant upward pressures on prices in an environment of accommodative monetary and fiscal policy. Inflation remains too high and too stubborn. The February PCE inflation data showed some improvement, but recall that in January, the data were a bit stronger than analysts expected. So while the level of inflation is lower than it was last summer, in February, the year-over-year measures of both total PCE inflation and core PCE inflation were in the 4.5% to 5% range, which is well above our 2% goal. And the story is the same with other measures of underlying inflation, such as the median and trim mean PCE inflation rates, which exclude components with the most extreme movements each month. Measured year over year, both of these measures are between 4.5% and 6% and have shown little to no improvement since their peaks last August. Now, the disaggregated data show that the inflation stubbornness is due mainly to the prices of services. Goods inflation has been moving down over time, although it remains considerably above where it was before the pandemic. Shelter price inflation has not improved, but the slowdown in housing activity and the deceleration in rents and new leases will eventually show up in the inflation statistics. Inflation in core services excluding shelter has not improved either. It tends to be sticky, is correlated with wage inflation, and is a much larger share of the overall index than goods or housing, since consumers spend a larger share of their income on these services. Now, for much of the pre-pandemic expansion, core goods inflation was slightly negative on average, and falling goods prices were pulling inflation down. By the end of that expansion, inflation was nearing our target. In January 2020, PC inflation had reached 1.8%, and core inflation had risen to 1.7%. That reading reflected 0.75% deflation in core goods prices and 2.5% inflation in core services prices. This is very different from today. Since the current period of high inflation started in the spring of 2021, core goods prices have been rising. And through last September, inflation in core goods exceeded inflation in core services. To achieve our long-run goal of 2% inflation, we're going to need to see continued sustained disinflation in both components. Now, my expectation is that with tighter financial conditions, demand in product and labor markets will continue to moderate. Output growth will likely be well below trend this year and pick up a bit next year. Employment growth will slow, with the unemployment rate rising to 4.5% to 4.75% by the end of the year. So far, high inflation is not unanchored medium and longer term inflation expectations, which remain at levels reasonably consistent with our 2% inflation goal. And that continued anchoring of inflation expectation is an important factor underpinning my outlook that we will see a meaningful improvement in inflation this year, with inflation moving down to 3.75% this year, continue to improve next year, and reaching our 2% goal in 2025. In my modal projection, to put inflation on a sustained downward trajectory to 2% and to keep inflation expectations anchored, monetary policy moves somewhat further into restricted territory this year, with the Fed funds rate moving above 5% and the real Fed funds rate staying in positive territory for some time. Now, my forecast is similar to the modal forecast of FOMC participants released 2 weeks ago, although I see somewhat more persistent inflation pressures than the median forecast among participants. Of course, I also recognize that there is heightened uncertainty around the outlook, and in such an environment, it's going to be particularly important to continue to collect and assess the whole panoply of incoming information, not only official government statistics, but also regional information gathered from our business, labor market, and community contacts, a variety of surveys on economic and banking conditions, and higher frequency data such as credit card spending. Now, all of this information can help us determine not only where the economy has been, but where it's going, which is particularly important when setting appropriate monetary policy, since it affects the economy with a lag. The FOMC likes to say that its policy decisions are data dependent. Now, it would be wrong to interpret this phrase as saying that we will react to 1 or 2 data points. Instead, I view data dependent as shorthand for saying that incoming economic information informs my economic outlook and my assessment of risk, which in turn inform my view of appropriate monetary policy. So you can see why we need a shorthand for that. Now, in making its monetary policy decisions, the FOMC is always guided by its strong commitment to achieving its statutory goals of price stability and maximum employment. The FOMC has come an appreciable way in bringing policy from a very accommodative stance to a restrictive one. We've taken actions to address the stresses that emerged last month in the banking system. Our decision in March to raise the Fed funds rate by another 25 basis points reflected the persistence in underlying inflation and the need to move policy into a sufficiently restrictive stance to return inflation to 2% over time. Precisely how much higher the Fed funds rate will need to go from here and for how long policy will need to remain restrictive will depend on how much inflation and inflation expectations are moving down, and that will depend on how much demand is slowing, supply challenges are being resolved, and price pressures are easing. The FOMC indicated in its March statement that it anticipates that some additional policy firming may be appropriate. In determining the extent of future increases in the target range, the FOMC will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. Now, even before the recent stresses, banks had begun to tighten their credit standards. Credit has become less available as interest rates have risen. Now, this is a typical way in which monetary policy tightening transmits to the broader economy. The recent tensions in the banking system could well result in banks further tightening their credit standards, and households and businesses may become more cautious in their spending. Directionally, we know that credit conditions are likely going to be somewhat tighter. And we'll be assessing the magnitude and duration of these effects on the economic outlook to help us calibrate the appropriate path of monetary policy going forward. Now let me conclude by noting that this is the standard operating procedure for monetary policy, evaluating the implications of economic and financial developments for the economic outlook and adjusting the monetary policy path if needed. Now, this is different from using monetary policy to address the stresses in the banking or financial system instead of pursuing our monetary policy goals. In fact, both price stability and financial stability are important for a healthy economy, and I don't see a trade-off between the two. Well-formulated and well-communicated monetary policy that achieves our dual mandate goals of maximum employment and price stability supports financial stability by allowing households, firms, and financial institutions to make better investment, saving, borrowing, and lending decisions. A healthy financial system provides valuable credit, risk management, payment, and liquidity services to households and businesses in support of a sound economy. An unstable financial system can propagate adverse macroeconomic shocks over broad economic sectors and over time to the detriment of macroeconomic stability. Because a safe, sound, and resilient banking system is of first order importance to our economy, it's vital that we effectively use our microprudential tools of regulation and supervision and our macroprudential tools, including stress tests, to keep the banking system safe, sound, and resilient. Doing so has the benefit of allowing monetary policy to remain focused on bringing inflation back to 2% in a timely way. And this is a very important duty because returning to price stability is necessary for the long-run health of the labor market, the overall economy, and the stability of the financial system. So thank you for your attention, and I really am looking forward to our discussion.
Well, thank you very much for those remarks. For those of you who are new to MMNYU events, we have a somewhat drawn-out Q&A process where we ask questions, where we go from table to table asking questions. While you think of your questions, I'll take the prerogative of asking the first one. So, President Mester, talk to us a little bit about what you think the lagged impact of policy interest rate hikes have been on financial stability. To what degree has the turbulence that we've seen in the banking system in recent weeks been a function of interest rate changes earlier on in the year and last year?
Yeah, I mean, I think the way I interpret what happened in March in terms of the banks is there were a few banks, you know, a handful, a small number of banks where stresses were emerged. And the Fed took some quick action with the Treasury and FDIC to make sure that those stresses didn't contagion out to other banks, other healthy banks. And so far, that has seemed to have stabilized things at the moment. But we're still going to be very much focused in on that to ensure that we make sure that firms still have access, or financial institutions still have access to liquidity. Again, I don't want to extrapolate from a handful of banks to a broader issue. I think we've been very much, communicating what our path of policy has been since we started raising rates, where we thought policy needed to go. We've made a lot of progress on that in terms of bringing basically from a very accommodative policy last year, you know, in the spring of last year, to where we are now in terms of restrictive policy. And I think our job is to make sure that we continue to communicate that and our reaction function to the markets, to the public in general, to firms, to businesses.
All right, thank you very much. Just over here.
Yep. Hi, thanks for joining us. So this Silicon Valley thing has unveiled a fault line in our financial system that I don't think a lot of people appreciated. You know, on the one hand, we have 30 systemically important banks, or 29 now. Credit Suisse was one of them. And you know, they have trillions of dollars that they get to, you know, their primary desks get to work with the Fed, and, you know, they make money off of that, and they take those excess reserves and they park them at the Fed, and they make money off of that, 4.9%. And then to the extent that they have extra cash beyond that, they can reverse repo that to the Fed and get 4.9% on that. trillions of dollars, maybe all told, $4 to $5 trillion, earning almost 5% a year to do nothing. Now, on the flip side, we have over 4,000 banks in this country that, no disrespect to the folks from Citibank and other banks here, but they have to work a little harder for a living. They have to go to the Rotary Club, they've got to speak at charity events, they have to go to a small business association, they have to know the CEOs of all their local firms, and they have to take risk. They have to put risk on their balance sheet, and some of that may go wrong. Silicon Valley Bank may be the most egregious of that, but in the end, they had mortgages. They didn't have crazy CDOs or any kind of leverage and weird crypto loans. These were high quality liquid assets. And now, if you're a Silicon Valley Bank or a bank like that, not only do you not take advantage of all those funds that the Fed is giving to the systemically important bank, but the actual opposite happens. You're now posting them back to the Fed and paying 4.9%. So your profitability relative to the systemic banks is seriously eroded. So my question to you is, if I'm a CFO of a local firm and I've got $5 million and I'm concerned about the profitability of my local bank, why wouldn't I then just put my money with a big systemically important bank? And are you concerned about the systemic problem that may create where some banks just no longer can compete anymore?
Well, I think that it's important to have a viable banking system with banks that have of all sizes. I certainly believe that I talk to bankers all the time in my district. We have some larger banks in our district and small community banks, and they are all trying to do the best they can in terms of risk management, right, and also to lend in their communities and to actually support businesses and households so that they have credit, can offer credit. So this is a challenging environment, no doubt. We're undertaking, the Fed is with Vice Chair Barr is undertaking a study of what actually happened in Silicon Valley Bank so that we have a better insight into actually what happened there. But you're right in terms of, you don't want to find yourself in a situation where the Fed has to take action that we had to take in mid-March, right? And so, my bottom line is we have to make sure that we're being very effective in how we do supervision and regulation so that we can avoid being in the situation we found ourselves in last month. And whether that means that we have to learn from this incident and change how we're doing some of the things that we're doing in terms of supervision and regulation, that remains to be seen. That's part of what the study is going to be. But no doubt, bankers, at least the ones I, talk to all the time, right? It is a challenging environment for them. They are doing the best they can in terms of risk management, and certain banks are better at risk management than others. So, I think interest rate risk is bread and butter of banking. And, you should be knowing that, interest rates were going up and you should have been taking precautions in handling your interest rate risks.
Over here. Please, everyone, raise your hands. We need some more hands up.
Thank you for speaking to us, President Mester. Barry Cohen from Caventor Capital. My question has to do with inflation and the fact that in this period, inflation seems to be vexing both market participants, the Fed, and economists, as the fact that it's gone up quite a lot, but it seems to be very sticky coming down. There's been a lot of discussion that some of that stickiness may be related to economic concentration within the markets itself, monopolization, mergers and acquisitions that have gotten to be inflationary in themselves in the way they pass through cost increases to consumers, and they have more pricing power than they used to have. If this is the case, and I don't know if you believe it is or not, but if it's the case, are interest rate hikes effective against this sort of inflation?
I mean, I know there's discussion about, whether the economy has become more, is there more market power now in the economy? But frankly, I think that's not the main driver of the inflation that we've seen. I mean, you can go back to when inflation started picking up, and bottom line is, we had an economy that was a new economy, right, in terms of we had the pandemic, right? The economy shut down, the economy picked back up, we had constrained supply because of that effect, and then we had very much high demand, and we had an underlying policy, both fiscal and monetary policy, that turned out to be too accommodative given where the economy was and where it was going. So bottom line is this is a typical what causes inflation, right? Accommodative policy. And so what we've been doing in the Fed is trying to change that, right? We moved from a very accommodative policy to a restrictive policy, and we're seeing that affect the economy in the right way. As you say, inflation has come down from its peak of last summer. It just needs to come down further.
Thank you. Yelena Shlyateva from BNP Paribas. Just a quick one. I totally understand that it's about the totality of data and in terms of the data dependence, but sometimes some data mean more than others. And given the current circumstances with the banking sector, so how big of a deal is it usually the senior loan officer survey update from the staff at your FOMC meetings? So in normal times, and how much will it be of a deal coming into the May meeting?
Right.
Thank you.
Okay. So we look at the Senior Loan Officer Opinion Survey, SLOOS, as we like to call it in the Fed, right? I look at that all the time. I mean, so that's one of the pieces of data that I look at, and it's certainly part of the committee's discussion. But you're right, in this particular point, right, given what happened in March, right, it's going to be particularly useful to, talk to bankers. The survey data is going to be very important because it's going to give us a sense of whether firms, financial institutions are pulling back even more on their credit standards, right? We already saw that happening, which you'd expect to see as interest rates moved up, right? So that was kind of the normal thing. Now we're going to be really assessing, okay, is this even a stronger impact? Because that's going to matter, right? Because we're trying to calibrate our monetary policy, and tightening of credit conditions is the mechanism through which that's going to impact the broader economy. So I would say certainly I'm going to be paying even more attention to it. And of course, we engage with a number of businesses, community, contacts, bankers as we go through the periods in between FOMC meetings, and that's going to be particularly important now to sort of get a better sense of, how much are credit standards tightening. That's going to be an important factor.
We'll do a quick lightning round over here. We have 3 people, so you each have to ask 3 super short questions, one after the other.
Okay, real short. Switching to unemployment rate. What level of unemployment rate do you feel triggers enough of the labor market being on side with you in terms of disinflationary forces that gives the Fed the room to begin to cut rates?
Thank you very much, President Mester. Ebrahim Rabari from Citigroup. You've been very clear about the role of inflation expectations, and I hope I'm not misquoting you. You used to say that the dangers of doing too little were greater than doing too much. Now, in light of, let's call it the banking instability that we've seen, and the gentleman argues could be enduring, how might that have changed that balance of risks, and not just specifically about the banking sector, but also potential economic nonlinearities that we're not yet aware of?
Thank you very much for your remarks, Igor Tesaritz, Millennium Management. And I'm actually going to piggyback a little bit on Ebrahim's question there about that balance between financial stability and fighting inflation. You mentioned in your speech that you find those 2 topics quite separate. And yet, thinking about the March meeting, there was talks about 50 basis points hikes, then ended up being 25. Chair Powell said there was talk about not hiking at all. So would you, going forward, would you personally be willing to turn a blind eye for a little bit on the fight on inflation if an episode like in March were to happen again, or if something worse were to happen in the banking sector? Thank you.
Well, okay. All right.
We were experimenting with this. I'm not sure it's a good idea, but.
No. I just have to remember what the questions were. So, look, as much as possible, and that's as much as possible, that's an important phrase there. You know, I want to keep monetary policy and financial stability apart and use the appropriate tools for each. So I'm not ignoring financial stability, but I want to be able to use our micro and macro prudential tools to focus on that so that we do have the scope to really use our monetary policy tools to focus on our macro stability goals, price stability, you know, maximum employment. So obviously, right, if an incident were to happen and something came up as it did before the FOMC meeting, it's reasonable for us to have sat down at the table and said, okay, you know, what should we be doing in this environment? But, you know, we had taken, the Board of Governors had established the bank term funding program, right? The actions were taken with Treasury, right? So there were actions in FDIC, so those stresses, right, had calmed enough that we can move ahead. The idea of whether it would be 50 or 25, right, that's really a judgment call now of, given what's happened, where do we think monetary policy needs to go? So, you know, early in the year, you know, data had come in stronger than many people had expected, which brought 50 basis point back into the discussion, right? But you have to recognize now with, you know, banks perhaps, you know, tightening credit standards even more than they were going to, you know, internally. So it's this mechanism through that's why I was trying to say, it's the mechanism through the outlook, right? So, you know, something happened, something changed, right? It has an effect on the economy, perhaps, right? How do you take that into account? And then what is policy, what's the appropriate policy? So that's basically the way you do monetary policy all the time, right? Conditions come in, right? You think about what does that mean for the outlook and risk, and therefore, what's the appropriate policy path going forward? So I was very comfortable with moving ahead with the 25 basis point increase at the last meeting. And we're going to do the same kind, right, of evaluation as we go into the next meeting and so on. In terms of the unemployment rate, you know, I think, you know, my policy path has the unemployment rate, it is going to, I assume, going to go up this year. But I do think we're going to have to keep, right, the funds rate, right, restrictive for some time in order to make sure that inflation is on that downward path to 2%. So I still think that, you know, we have more work to do on inflation, and that's where my focus is. But obviously, we've come a long way in terms of bringing the funds rate to a restrictive stance, right? We're not going to be doing the same amount again, right? So we're going to have to keep looking, right? And now we're getting into the part where, you know, we're evaluating going forward. And that's, I think, the right thing to be doing in terms of making sure that we are, you know, getting inflation down back on this path to 2%, but also being very attuned to the risks that are out there. And you know, there's a lot of uncertainty in the economy still, even regardless of the banking, right? There was heightened uncertainty around the economy regardless, right? Then the banking stresses happen, and that's another uncertainty. So you have to be attuned to this uncertainty as you go forward. But my own view is that we still have an inflation issue, right? Inflation is too high, and we know it's stubborn, and we're just going to have to keep at it in order to make sure that inflation is on that path down to 2%. I do think it's crucially important for the long-run health of the economy to get back to 2% inflation.
Over here.
Hi, Abby Smith here, Southern Ridges Capital. Thank you for being here. You talked a little bit about extrapolation, right, from the Silicon Valley Bank. To add on to their questions, I guess, the market has definitely extrapolated from that event. I think that they're pushing back a lot on whether or not it's accurate. I think a lot of your rhetoric, a lot of your colleagues' rhetoric, which I'm absolutely on board with, but I guess the question is, how do you think that we're going to remedy the difference between what the market is pricing in and again, this extrapolation, which the market is priced in after the events from March, and everything that you have said, everything that your colleagues have said in terms of we're not looking for cuts, we're not looking for the extreme scenarios to continue in terms of the banking crisis going forward. I guess the question is, what do you think will change that and get in between that differential between what you're saying and what the market is now extrapolating?
So you're extrapolating about the funds rate path in the market is what you're talking about, right, and interest rate. Well, we'll see, right? We've seen cases where, right, we've had a view at the Fed about where the economy is going, and we've seen the market have a view, and then that's kind of what happens, right? They have a view, we have a view, we get more data in, and we decide, which direction we're going. You guys decide as market participants sort of where you want to place your bets. I can tell you what drives us is that we need to get back to 2% inflation and maximum employment, and that's kind of what our guide is, right? And we're going to do what we have to do with monetary policy to get there and to make sure that inflation is moving down on a sustainable downward path to 2%. So, we take signals from the market, obviously, like we look at what the market's saying and we're saying, okay, they have a different forecast than we do. Why? What are they seeing in the data? What are we seeing in the data? That's very important. And moreover, right, financial conditions are part of our assessment of how policy is affecting the economy. So that's another avenue through which, right, what's happening in the financial markets do affect our decisions about policy. But we've seen these juxtapositions before where, the markets have one view of the world and things come together. So we'll see. I'm going to be very attuned going forward to what the economy is doing, right? And so I'm going to be very interested in, what's happening in the financial markets, and in particularly what's going on in terms of credit conditions and tightening of credit conditions, because we have seen episodes like this where credit conditions did tighten, and we want to make sure that we're incorporating that into our monetary policy decisions.
Thank you for your time, President Mester. My question revolves around SMBs. Small and medium-term businesses are the backbone of the U.S. economy, and given the recent stress in the banking system, which will likely lead to tighter lending conditions, how resilient do you think these SMBs will be, and how do you think that affects the labor market going forward?
Yeah. Okay, that's a really good question, and that's one of the things that when we go out and talk in our districts, we talk to a lot of small businesses, and we talk to a lot of small bankers, and that is something that both sides, right, agree that bankers know that, right, they're an important factor for small businesses. Small businesses know that having access to credit is important for their health, and that's why this focus on what's happening in the banking industry going forward is going to be important given what happened in March. So far, right, the small businesses are telling us that they are doing okay. They still have, many of them still have desire for workers, but they are also seeing what's going on in the economy, so they've become a little more cautious than they were before. And similarly with banks. Banks have also, they recognize that they're adjusting to what's going on in the economy and the fact that interest rates are going up. They also are starting to tighten their credit standards. But so far, right, this is the normal activity that you'd expect given interest rates are moving up. So there hasn't been this extra bit yet, but we'll see. That's one of the things that we're going to be evaluating. But you're right, that's going to be an important factor about how fast the economy and demand slows.
Do you mind taking a couple more questions? Or? Sure. All right, fantastic.
Hi, Mike Chambers, Atlantis Bank, Hudson, New York. President Mester, thank you very much. I think you and your colleagues should be put up on a pedestal, so thank you for coming. Simple question. We've heard lots of stuff about inflation, incredibly rapid rise of rates. One thing we haven't talked about is something that when I started in my career decades ago, much longer than I'd like to admit, was money supply, and the M numbers were always the most important numbers that came out. We haven't talked about the Fed balance sheet. We haven't talked about money supply. Perhaps that might be the key to bringing inflation into control at a more rapid rate. We've seen an absolutely historic rise in rates, and yes, we're seeing inflation come down, but not at a rate that us or the Fed are happy with. So perhaps money supply and the M's is more important. I'd love to hear your thoughts on that.
Yeah, I mean, I don't really think so. However, you know, your point about looking at the balance sheet and making sure that you're incorporating that into how you're thinking about, you know, your policy, I think is important. So, I mean, just the way we implement monetary policy now is very different than it was in the past when the money supply was sort of the key variable that we looked at. So that's why I think that. But you're right? We are letting the balance sheet shrink, and letting assets run off the balance sheet. And that does have an effect on the stance of monetary policy. Now, what we've been doing, which I think is the right thing to do, is allowing that to just be kind of in the background, passively doing it, right? That doesn't mean we're ignoring it, because it will have an effect on the economy. And then we're using our interest rate, right, as the main sort of active tool of policy. And if the way to think about it is, if we weren't doing anything to the balance sheet, perhaps the funds rate would be at a different level. But because we're doing something to the funds rate is the level that we think is the right level to get inflation back down to 2%. So I think that mechanism is still the right mechanism, but your broader point is there's more things going on than just the Fed funds rate. And that's why a lot of, when we're out talking, we talk about overall financial conditions, because we understand, right, that the Fed funds rate is just one interest rate, and then it's what does it imply about the rest of the interest rates? Your point is a good one. It's not just even the interest rates, it's what's going on with the balance sheet. What does that imply for the rest of the interest rates that then affect the economy?
Thank you, President Mester, for your speech. Elisabetta Cavallo from Brevan Howard. I would like to reconnect to one of the questions asked before about the current market pricing. So the market is effectively pricing the start of a cutting cycle from the second half of 2023.
Can you just talk?
Sorry. So I would like to reconnect to one of the questions asked earlier about the current market pricing. So the market is effectively pricing the start of a cutting cycle from the second half of 2023. So my question is, does any of the scenarios that you might have considered when building your forecast agree with the current market pricing? And if so, what would that outlook look like in terms of what would need to happen in the economy for the start of a cutting cycle to effectively happen from the second half of 2023?
So you want it basically to work backward from what the market path is. Okay. So can I come up with scenarios that would have the Fed cutting interest rates? Yes. Is it my modal forecast? No. But you know, we understand we're in an uncertain environment, and so things can happen. And shocks that, you know, we can't, I mean, the nature of shock is you can't predict it, right? So something could happen. Right, but if you look at sort of where I think the economy is and where it's going, right, I think we're going to have to keep, we're not going to keep, let me say it this way, we're not going to keep raising interest rates until inflation gets back to 2%, right? That would be wrong, right? We've got to be forward-looking. We know that our policy affects the economy with a lag, right? If, you know, things play out the way I anticipate, right, I do think we're going to have to move interest rates up from here a little bit more, right, and then hold it there for some time, real rates restricted for some time, so that we're assured that inflation is back down to 2%. But, you know, if the economy evolves in a different way, then we're going to be using that to inform our outlook, and we will set, you know, a different policy path if it's appropriate. But again, we're still always guided by the two goals that we have from Congress, which is maximum employment and inflation at 2%, which is the way we've interpreted price stability. And that's the real driving force here. So if the economy evolves differently and we can get to inflation faster, you know, our policy path might be different. But my own forecast is that it's been stubborn, and I expect a little bit more persistence, which means that we're going to have to keep the funds rate up for some time.
All right, we'll just try to get a couple quickly in here in the corner. Maybe we'll do a two-person lightning round here. So,
thank you for your remarks, President Mester. For 10 years in this group, we've been discussing how stubbornly low inflation was, right? I mean, like, we seem to have forgotten all that. It just took 2 administrations with some, aggressive fiscal policy to totally end that problem, at least for now. Don't you think it also works in reverse, more effectively, and in a more directed way? And I'll tell you why I'm asking this question. Unlike 07, 08, we don't have a speculative real estate bubble over construction. We have the opposite. I mean, this young gentleman lives in Williamsburg here, and ask him what's happening to the housing market, out there. I mean, millennials don't have homes. At age 35, they're living with roommates. Your raising rates is curtailing the supply of housing, correct? Which is going to keep rents stubbornly higher. Your OER is not going to come down, and it is, 1/3 of your inflation measure.
we'll let him ask a question in the next lightning round.
Yeah, you mentioned the forward-looking component, but in the past you've kind of cited a backward-looking component as well, saying that you need to see a series of several good inflation prints before thinking about a pause. After the events of this last month, is that still the case? Do you still think we need to get that backward-looking evidence that inflation has slowed, or is the expectations piece alone enough to actually pause rates at this point? I guess a quick follow-up too would be, do you consider the last few inflation prints we've seen good?
Well, inflation is moving down, which is good. Do we need to sort of see backward-looking information? Yes, to the extent that that actually helps predict future, right? So again, we want to be forward-looking, but we have models, and I think some pretty good models. We have an inflation research center at the Cleveland Fed, which does a lot of inflation modeling. So the reason the backward information is important is because it actually tells you something about where inflation is going. So yeah, we're going to still need to see inflation moving back down, and it's been pretty stubborn. So I would like to see more progress than I've seen. In terms of, yeah, there are long-term structural problems in the housing market. And I kind of alluded to that in the speech, and you're right. Affordable housing in particular is a problem. I don't think of that as being a monetary policy issue, right? So we're raising interest rates, and yes, it's going to affect the interest rate sensitive sectors, including housing, of course. But we need to do that in order to get inflation back down. And there are other policies that perhaps other groups who are responsible for them could think about and implement that would help some of these longer term structural issues in the housing market.
Okay, well, anything left in this corner? Or one last question, and then we'll wrap this up. So,
thank you, and thank you, President Mester, for a clear presentation. I want to ask you about the long-term anchoring of interest rates. Now, last year my issue was a lot of Fed officials were signaling 2.5%. We need to get back to neutral, which is 2.5%. You correctly said it was an error of omission because that was really the long-term inflation rate and we were above that. But what about the other side of the equation, the 50 basis points in real rates? Because we now have a market where 10-year real yields in PC price terms for the last 6 or 7 months have been between 1.3% and 2%. John Williams has not been publishing any R-star estimates. He suspended those in the third quarter of 2020, and that was a big intellectual basis for the lower rates. So what about the signaling that the long-term rates, 50 basis points, when the market's perhaps suggesting we're moving back to a more normal world and it should be somewhat higher?
Yeah. So, I mean, as you know, all the estimates on the stars are with error bands around them. They are guides to how policy is, but I'm going to go back to what I apparently said before, which is there's long-run R-star and there's short-run R-star. In the environment we're in, right, we need to have real rates higher than they are in order to get inflation back down. and whether you interpret that as a rule of thumb, say, take year-ahead inflation forecast and use that to derive what your real rate is, or whether you want to look at a long-run R-star and say it's temporarily higher. Either way, right? But nonetheless, right, the models and our forecasts and what actually has been happening in the economy suggests that we probably need a little more tightening in terms of the real Fed funds rate, right? And then allowing that real Fed funds rate to stay up for some time in order to get inflation down. Where, once we get back to price stability, the long run R-star is, I don't think we know that yet. There's a lot of smart people who think that it will fall back down to be lower than it was. There's other people who say, no, it'll end up being higher than it was. I don't think we need to know that right now. It's not like job one, but it's an interesting question about where the economy's going after this. So.
All right, so we're past time. I would like everyone to thank President Mester. We had a lot of questions about inflation. We did inflation questions. And our next event will be pretty soon, actually in 2 weeks. We'll be back at our old haunts at the Downtown Association downtown with President Williams of the New York Fed. So please look out for an email tomorrow or the day after. Please consider coming. Please sign up. We look forward to it. Again, one more hand for President Mester. Thank you for a fantastic event.